Warned it before, and he's saying it again. Former Federal Reserve Chairman Alan Greenspan warning of a pop in bonds as inflation will climb. In a Bloomberg interview yesterday, he said, by any measure, real long-term interest rates are much too low and therefore unsustainable. We are experiencing a bubble, not in stock prices, but in bond prices. This is not discounted in the marketplace. Well, still with us is Phil Camporeale of JPMorgan Asset Management. Phil, you agree?
So I think the market is digesting interest rates a lot better than what they had in the past. Now, can we see a taper tantrum-like event? Sure. I mean, I think interest rates can jump. I think that Brussels or the ECB probably has a lot more to do with our interest rates than the Fed does. So Mario Draghi will be at Jackson Hole this month for the first time in 5 years. So there's a lot of talk around whether that's signaling their normalization of policy. Listen, the interest rates are very, very low now because of how low global interest rates are. So if bond rates move higher, I think that can cause some indigestion. But if you look at what's happening this year, the Fed is more explicit than they ever have been on normalizing their balance sheet. And they've moved twice as many times in 2017 than they did in 15 and 16. And all those financial conditions we talked about in the last segment are easier. Right? So I think the Fed is in a much better place in terms of communication than they were when the taper tantrum happened and when 2015 happened when they started moving rates. But yes, we would agree. A 2.3 10-year Treasury rate right now is pretty darn low versus where economic growth is and what the Fed is telling us they want to be doing.
But it seems increasingly the research that comes in is you have to have a constructive view on inflation in order to have a constructive view on the market. For example, David Kostin is the perfect example. He said, look, I think inflation's picking up. That's why I'm not raising my S&P forecast. You're only going to get the 2,600 if you wind up seeing higher inflation. But nobody knows what's going to happen with inflation. So how do you square the two? And if we don't get that rise in inflation, we're due for some kind of big pullback here.
So I think what the as far as the S&P is concerned, reflation is very different than inflation. What does reflation mean? Reflation means that central banks are hitting their 2% targets. Inflationary, go back to the bond vigilantes of the 90s. Inflationary means that inflation expectations are moving out of control higher, and the Fed is being perceived as being behind the curve. That is not what the S&P wants to see. That is a very tight environment where the Fed has to catch up. Reflationary, Alex, if we can get that, if we can hang out at around 2%, is good for the stock market. I think that a bad scenario would be kind of a trip back down on 10-year Treasury rates to the lows of last year because inflation disinflation is happening. So inflation keeps falling.
I want to get back